Let's come back home to Nigeria. The country's GDP, gross domestic product data for the final quarter of last year came in a few hours ago, showing a 3.84% growth level. In real terms, that's about 0.38% improvement over the same period of 2023, according to the data released by the Statistics Office. The report reveals that the growth in the final 3 months of last year was driven largely by the 5.37% expansion in the services sector, which contributed 57.3% to the total GDP. Let's get the first word on this from my guest here in the studios, Aina, the Managing Director at Cordros Asset Management. Thank you for coming in. First time in the new year.
Thank you,
It's never too late to have a handshake.
Happy New Year.
It's good to see you.
Yeah, it's been a while.
Thank you so much. It's been quite a long while. But we appreciate your being with us on the show, not just here on Global Business Report as well, on the Arise Exchange. So we appreciate your contributions. And of course, your data from Cordros Capital every day, which we use. Some of those numbers are from what you send to us on a daily basis.
You're welcome, boss.
Equities and all the markets, fixed income, currencies, and what have you. So quite very robust. But let's give me your first one. What's your take on this latest economic news on the GDP for the fourth quarter?
Well, I'll say a bit impressive, because it was slightly higher than a lot of estimates. Consensus estimate on Bloomberg was about 3.10% for Q4, and this came in at 3.84%. We are projected 3.7%, so slightly higher than our estimate. But I think the beautiful thing is that we are beginning to see the reforms begin to take shape, begin to kick in. And even though it's been a long road, it's been a painful road, but some of the reforms are beginning to kick in. I think something that was notable was in terms of oil production, as our Q3 was 1.7 million barrels per day. For Q4 was 1.57 million barrels per day. So we've seen an increase in oil production. Even though the GDP still largely skews towards the non-oil sector, which according to data was 95.40%, while oil sector had 4.60%. But I think things are beginning to take shape. And I think from an economic perspective, even though the journey has been painful, I can say that things are getting better. And if you look at some other metrics, inflation data, even though it was rebased, is lower than where we are coming from in December. Current account balances, balance of payments. In terms of external reserve, is 9 months of import cover. So things are beginning to look very good. And in terms of even exchange rate, currency has been pretty much stable, hovering around 1.5, 1.4 in recent time. So I'll say that things are going to look good. And 2025 is definitely going to be a better year from a GDP perspective.
In terms of analyzing the years, as it were, 2023 was the election year, and we got those two major shots fired.
Yeah.
The exchange rate and the fuel subsidy in the second half of the year after the new administration came. So that was the year. Then you've got 2024, the first full year after those two major policy pronouncements.
Absolutely, yeah.
So can we say that 2025 now begin to look at that year after the initial shock of 2023 and 2024? Do we fully understand now how the policies are looking like? Do you think we have a better sense of where things are going?
Oh, definitely. So for 2023, the election year, overall GDP was 2.7, thereabouts. And average GDP for 2024 was 3.4, which of course showed an improvement. So a lot of the painful reforms has already been taken. Energy, electricity prices, fuel prices, exchange rates. How worse can it go from there? So I think a lot of the painful reforms have been taken, and we don't expect to see even more painful reforms, even though there's going to be some reforms, but not as painful as we saw in the last 2 years. So I would say 2025, I think it's going to be a lot better than where we are coming from.
Because when I hear optimisms like such as this from market professionals, analysts, and executives like yourself, I begin to say, how do I get that message across to Nigerians who would want to say, look, but we're going to get to that a bit later in terms of the exchange rate, which is a major issue, and fuel pricing are still these highly elevated level compared to where we're coming from 2 years ago. Yeah. So try to help me get a sense of that. Let's get back to the trading day. We got the rebased inflation data for January last week. Then that was followed by the central bank rate hold decision on Thursday. Then the stock market goes into a tailspin. Should I forget stocks for now?
Well, I'll say forget stock at your own peril.
Oh, here we go.
No, you can't forget stock. So there are still a lot of attractive stocks in the markets. I think the Nigerian market is trading at a discount as an attractive PE compared to other peers. So you can't forget stocks. What I would say is that even though inflation rates came lower, it was rebased, and there was a lot of factors. The base years was changed from what it was before to 2024. And so we saw the rates move from 34.8 as of December to 24 over in for January figures. And if you look at some of the core items, food inflation came down from 39 to 26. Core inflation also came down from 29 to 22 as well. So what I would say that we might not see an aggressive disinflation. We think the inflation is going to hover around where it is at the moment. We think because of the base effect that has already been kicked in. However, you can't forget the stock market. I think that, at least from what we've seen in exchange rates, one reason why a lot of the FPI stayed in the fence was because of currency. And I think where exchange rates is now, a lot of them are comfortable with the currency. And I think sooner than expected, we might begin to see some influx of FPIs into the market.
Is the rally out of stocks when yields were going up and interest rates highly elevated last year, 2 years ago? Stocks were bouncing and everybody was saying, look, the stock market is where we should be. Has the party moved now to the fixed income space? Treasury bills, bonds?
Well, so the party was in the fixed income space, still in the fixed income space, but it's gradually going to shift because now we're now entering a period of lower interest rates. Even though at the last MPC meeting was status quo, but I guess a lot of investors are already pricing in the inflation data. So at the last auction, they issued the 29 bond, they issued the 31 bonds, and it was massively oversubscribed, about 3 times what we were going to offer. And those rates came down at 19.2 and 19.33 respectively. And on the back of that, we saw investors aggressively buying those yields. So what is happening is that they're trying to play the duration play, because obviously they know that yields are going to come down. So when you know yields are going to come down, you want to elongate duration, go as long as possible into the future. So when yields come down, you are not affected either by reinvestment or by investing at a lower yield. So that's what's happening.
So we're looking at fixed income right now. Folks are buying into long-dated instruments as far as bonds, treasury bills are concerned.
Yeah, so both. So there's long-dated in terms of bond, as far as 35 bonds, 31 bonds.
Yes.
Then we've seen a drastic decline in treasury bill yields.
Yes.
As of late last year, yields were as high as 30%. As at the last auction, yields were just over 22%. And that's a massive shift. Apart from that, the secondary market is already trading in 20% yield level and all that. So it's a no-brainer. I guess we just want to lock in as much as possible. So when yields decline, they are not investing at the lower yield.
So this happens when the NTB comes in and the rates goes lower for stop rates. The following sessions, we saw this massive inflow into the FMDQ, for example, and we saw investors throwing a whole lot of cash. Where's this all liquidity coming from?
Well, is a myriad of factors. So we have the money managers like ourselves, like PFAs, and we have the FPIs as well. At the last auction, we have about 2.2 trillion that was bidded for the long end, even though everything was not allotted. We've been seeing a lot of home auctions as well. We've seen FPIs. They seem to love the Nigerian story. They seem to love where exchange rates are at the moment, and we are seeing influx of MPIs into our markets.
So that's where the party is in terms of when you see trillions of naira.
Oh yes.
Individual function. Just looking at, look, there's so much money with you, fund managers, asset managers, PFAs, and what have you, and everyone is just chasing whatever yield you can get.
Absolutely. And for the FPIs specifically, is a carry trade. So for them, yields in their space is single digits. So why would I want to invest in single digits when I can come to Nigeria, convert to a currency that is stable, and get probably a 20% yield? So for them, it's a carry trade rather than invest single digits. They are coming to a country like Nigeria, getting double digits, as high as 20%, over 20%. Even for them, they're getting as high as 27%. So really, it's a no-brainer. They just want to be comfortable that the currency is stable. And once they are assured the currency is stable, we are going to see an influx of FPIs.
Well, portfolio investing under a new, or what can be considered a rate pause, at least by last week. And I'm not sure what you folks at Cordros, I'm sure after the afternoon lunchtime Cardoso and the rest of the team announced that it's going to be a rate hold. What's your take on that decision? Where do you folks think rates will go from here, and what that would mean for portfolio investors?
Okay, so the view or the outlook for interest rate is obvious. It's going to be lower, but we didn't expect a rate cut at the first meeting of the year. We thought it was going to be premature, it was going to be too sudden, and we thought it was going to reverse a lot of the progress they've made in terms of currency stability, because sometimes you need currency to be high for, you need interest rate to be high for your exchange rate to be stable. And one of the things that drove currency stability was because we had an attractive interest rate, and they're trying to target a positive real return. Even though when there was a rebasing of inflation, real return was a bit positive, but it went back to being negative real return. So we think they will start to maybe bring down rates, maybe from sometime in H2 or sometime in Q2, but not immediate, because they don't want to reverse a lot of the gains they've made on the currency.
The second meeting is in May, later May 19 and 20. You think we've got about, about 60, 70, 90 days, thereabout in between for I'm sure the MPC would want to see what happens.
Don't want to see proceedings,
yes.
but I'll say it's a 50-50 chance. If things begin to normalize, stabilize, there's a possibility that there might be a rate cut at the next MPC meeting.
If there's going to be a rate cut, by what margin do you think, do you folks think that the central bank should go?
Well, nothing aggressive for now, maybe 25 bips or at most 50 bips.
Just to test the waters?
Yeah, but it depends on proceedings within the next couple of weeks.
But what we have is the latest GDP for fourth quarter. So this is not a rebased GDP.
Yeah.
So this was as for the full year 2024 in the manner of speaking. So we've got full year 2024 on our hands. So go back to mutual funds. So with the interplay of exchange rates, inflation, rebased, and interest rate hold, what do you mean for what does that mean for mutual funds investors right now? Is there still when they look into their basket, everyone says, "Hey, hold on a second, will I still get my target for the year?"
Oh, great. So interestingly, the mutual fund as industry market has been quite interesting. I remember 2013, the entire mutual fund size was just about 130 billion. Now we are 4 trillion. So a lot of things have happened. We have new entrants in the market, over 100 players in the market. We have new type of funds, dollar funds, fixed income fund, balance fund. So whilst investors have options, what we've seen before, we've seen aggressive growth of the dollar mutual fund, occasion that guys or investors are trying to protect or hedge against currency devaluation. And so dollar mutual fund had about 42% in terms of market share, and followed by money market mutual fund. Money market mutual fund, because of the high interest rate regime, most money market mutual fund were given about 22-23% in terms of net return. So might begin to see a shift from that. Might begin to see more exposure into bonds in terms of investors trying to just protect their returns. Also more exposure into equity. I still think that equity is going to do pretty well this year because, like I said, from a valuation perspective, equities are very cheap. A mutual fund is just a vehicle. So mutual fund invests in the various asset classes. So I don't think the party is over for mutual fund. I still think that there's a lot of upside for mutual funds.
We'll talk about the mutual funds for exchange rate and what the exchange rate is doing right now in terms of where the numbers are. But let's talk about the FPIs. Let's chat to that a little bit. We see an increased inflow of portfolio investments now as the Naira stabilizes around 1,400, 1,005. Oscillating between those two numbers in and out. What are you professionals seeing as far as the exchange rate is concerned for Cordros?
It's very difficult to sort of
a bit dicey.
Give outlook on the exchange rate. But what I would say is that I think we're in a very comfortable position in terms of exchange rates. And I think rates are going to just overrun the 1.5 psychological level. I think a lot of things are in the favor of the CBN. We have healthy external reserve. The acquisition reserve has been quite positive, even though we've seen some reduction from about $40 billion to I think it's about $38 billion now. But in terms of import cover, it can support about 9 months of import cover. I mentioned that we have positive current account balances and good balance of payments. So those sort of metrics are looking good. So I don't expect to appreciate aggressively. And it's also in the interest of the CBN that it doesn't appreciate aggressively, because what we now see is that the FPIs rather take profits on currency rather than wait for whatever profit they are getting on interest rates. Because some of them came in at 1.6, 1.7. Just imagine the rate coming down to 1.2. That's about over 30% return.
Yeah.
So they'll rather take, and might now begin to see drastic exits of the FPIs, because for them, they're chasing return, and there's a return on currency, they'll probably book profits.
Let's step back a little bit. We went straight after the elections, nearly 2 years ago now, to around 1,900. And then we moved down a little bit to 1,008. And then we begin to correct a little bit to around 1,007, 1,004. There was still the black market or street rate, a bit of a converging with all the efforts that the central bank is putting out there. So, do you see, is it likely, are the days of sharp depreciation over? That's my first question.
I think so.
Are those days over?
Oh, yeah, I think so.
In which we saw that very sharp fall.
Judging by what we've seen in the last 1 month or 2 months, we've seen some stability in the exchange rate.
So the central bank's got a handle, got a hand on the wheel.
Apparently, yeah, they do. Yeah,
so there's no sharp depreciation of the Naira against the dollar. So investors can say, well, we're not going to see this go to 1.16, 1.7, 1.8, 1.9.
Well, I hope so.
that doesn't. But it looks like.
But the metrics
we're cruising around.
Metrics are looking good.
Okay.
And it seems as if we are cruising, and I hope that they just maintain things.
Autopilot.
Yes, I hope they just maintain things on there.
So, sharp appreciation, sharp depreciation. It's got consequences.
Oh yes. What is good for us is stability, and investors are able to price in when there's stability. They're able to forecast. They're able to invest when there's stability. Appreciation and depreciation really is not good for the currency, either ways.
But you can just switch in a few notches in and out. That can be managed.
Yeah, if it's gradual.
Not what happened in 2023, 2024, early part of the year.
Yeah, then it came as low as 1,100 or 1,000. Yeah,
yes.
It's set to go back up. Yeah.
Then just took off again.
Yeah.
So we'll say the Naira is trying to find its value. Is there any idea where the Naira is heading? From where its current position, what do you think the should be considered the new normal or the new reality of the Naira when Nigerians look at it? So we should just forget the days of 400, 800, those days are gone. We should forget about it and say goodbye to it. Is that a fair assessment of things?
We know 400 and 800 also has consequences. So from a revenue perspective as well, it means the government will not be earning as much because some of our revenues are in dollars. So just imagine you're converting to 400 Naira to $1.
So those days are gone?
So those days are gone.
Okay, we're just going to kiss it goodbye.
So but I think 1.5 psychological level is something that a lot of the FPIs are comfortable with, at least based on what we hear. A lot of them came in around 1.5, some of them even slightly lower than 1.5 in the last 2 weeks. So they're comfortable with that level.
Very interesting. Okay, let's chat to inflation now. We'll talk about it in a bit more details. What's your outlook on inflation targeting for the rest of this year? Again, we'll talk about exchange rate again. Just put that together for me. Vis-a-vis what the mutual funds in dollar assets are doing right now. Are folks a little bit jittery as to looking at where they came into those mutual funds in dollar terms, hoping to lock in some future value, and then they're seeing the exchange rate at this level? Is there any reason for them to panic?
Well, I'll say there's no reason. Well, because people invest in dollar mutual fund for different reasons. Some of them, they have foreign obligations. Maybe they're paying school fees, they're health bills. Some of them want to buy houses. Whatever obligations are different. For some people, I know they were speculating on the currency. So from a speculative perspective, I think there might not be too much opportunity to speculate.
I haven't heard that word for quite some time. It looks like the central bank has been able to cripple that.
Yeah.
I haven't heard that in a couple of months.
I'll say it's dangerous to speculate now. you might get your fingers burnt. Yeah. But there's still opportunities in dollar mutual fund because people have foreign obligations. People earn salaries in dollars. People earn bonuses in dollars. People have investment assets in dollars as well. So the mutual fund is just a vehicle that they can plug in those revenue that they're earning in dollars. But inflation, where do we see inflation? I still think inflation, even if it's going to decelerate, probably still around 22 to 24 levels. Even though the CBN is targeting 15.75 based on the budget assumptions. So that might not be achieved this year because it's been rebased already. But I think it's going to be a gradual deceleration. But for the end of the year, we still think it's going to be around 23, 24%.
All right. I'm not going to talk about single digits inflation rate. I'm just going to keep my mouth shut on that because I'm going to be, hey, boss, you've been living under the rock?
Yeah, but the good thing is that a lot of the reforms have been taken, PMS reforms.
Yes. So double digit at least by the end of the year, maybe the lower end of the 20.
Oh, yes.
Now we're doing 24.4.
Yeah.
Thank you so much. It's nice to have you here. You deserve a very great dinner.
Thank you, boss.
Quite insightful, as always.
Yeah, thanks a lot.
Nigeria's latest man. Thank you so much for coming through. We really appreciate your time on the show.